Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. My second call this week was to Andrew McHattie, the editor of Investment Trusts newsletter, for one of our regular catch-ups where we review some of the most interesting news headlines out of the investment trust sector over the last few days or couple of weeks in some cases. So, Andrew, we're recording this on Friday morning on June the 13th. And the news this morning has been dominated by news of the Israelis launching an attack on various Iranian targets. That is a significant escalation of what is already a very volatile Middle East situation. However, we'll mention that it's obviously the markets have sold off a little bit and oil prices have risen, but we're not going to concentrate on that. It's too early to know exactly what the implications of that are. There will be more volatility, that's for sure, until we find out how this latest development is playing out. Perhaps I could just ask you, before we start looking at the investment trust sector and the news there, what's your general philosophy when it comes to these kind of global shocks, if you like?
I suppose I draw on my longevity in the markets here and the fact that there's never a quiet moment, is there? I think I've heard the expression so frequently over the many years of my long career now that it's a difficult time for markets and there's a lot to worry about. But I think that's generally pretty much always the case. There's often geopolitical concerns, there's often macroeconomic worries, there's often things that aren't going well in the markets. And yet we make long-term progress, don't we? And so the market has a good way of assessing these threats and risks and generally moving on. And so I think it's difficult to separate out what is noise and what is actually of real fundamental importance. But I think it's a good idea not to get too hung up on the daily news cycle, particularly now, I think, with modern media, we're bombarded with so much information on a daily basis, and it doesn't necessarily impact prices and asset values that much.
Indeed, that is generally the lesson of history. I think we can all agree on that. And of course, it's also true that there's been speculation that this Israeli attack was coming. In the newspapers this week, President Trump actually referred to it explicitly in the last couple of days. So markets do have quite a good record in absorbing this information, and we don't know what the international ramifications of it all will be. Other than if we do have a prolonged conflict, we do know that oil prices are likely to rise, but they have been coming down in any event, and that could have economic consequences. Well, today, because this is still very fresh news, we're going to stick to talking about our normal topics, which is what's been going on in the investment trust sector and in the financial markets more generally. And my feeling is that we've actually been through a relatively benign period over the last few weeks since we last spoke. I'm getting the feeling, I don't know if you would share this, Andrew, that the market is sort of coming to terms with the new, if you like, Trump regime. In other words, we know we're going to be surprised continually by the things he says and does, but I think the markets are beginning to get the measure of him. Would you agree with that?
I would. I think the market had this massive shock in April when the tariffs were initially announced. And we immediately went into frightened mode, and the markets sold off right across the board. I mean, it was a risk off moment. But I think actually, once those tariffs were moderated and the market understood that those were being used perhaps more as a threat than as a definitive answer to his macroeconomic strategy, then I think actually everything settled down again. And prices came back actually quite strongly in May, and we had a good bounce in the markets. So I think, again, that was the market acting as a very, very good barometer of what's going on. And it does absorb this information and assesses it. And we had a good bounce back in a lot of sectors, including some of the riskier ones, which was indicating perhaps that the market was coming to terms with those macroeconomic threats.
Yes, I think the one kind of underlying issue that still we need to see resolved or come to some kind of at least a considered opinion is what's going to happen to the bond market and whether the bond market can absorb all the kind of debt that's being issued or proposed to be issued both by the US, the UK and across Europe. But that, for the moment, seems to have peaked. Those concerns about debt funding have temporarily, perhaps at least, eased a little bit. Well, we do know, of course, that the markets are very good at dealing with short-term interpretations, but they sometimes underprice longer-term issues, of which I think the potential fiscal crisis is one. But we're not going to concern ourselves with that one either this morning. We're going to talk about investment trusts, and we're going to start off in the commercial property sector, where there's been a couple of interesting developments, more corporate activity. I should say that next week we will be putting out another podcast, this time with Marcus Fairmudge, the manager of TR Property, who we often come back to find out what his feelings are about what's happening in commercial property. But it has been a relatively better period for this particular sector. And there has been quite a lot of corporate activity. So let's start off with PRS REIT, which has effectively been put in play following some shareholder activist initiatives. And we are seeing some news coming out of there, I think, Andrew.
Well, we are, and I think this relates very much to something we've discussed before, which is whether there will in fact be any investment company REITs left at some point, because they're slowly disappearing. And I think this one has been on the cards for a while, because you might remember that last summer, after a requisition from Harwood Capital, there were changes to the board that very much, I think, prefaced some likely corporate action here. And now that's arrived in the form of a possible offer of 115 pence in cash. Now, discussions are ongoing here, and the shares are about that price, so they're more or less just pricing it in. And we're promised a further update by the end of the month. So we'll have a bit more news to come here. And my feeling is that 115 pence doesn't really look like a very generous bid. It's a 17.6% discount to the trust's net tangible asset value at the end of December. And the shares had in fact spiked higher before this bid was announced, because there had been press speculation. I think Sky News actually was first to the beat here. And I think maybe shareholders were expecting a bit more than 115 pence. But we'll have to wait and see, because actually this trust is pretty tightly held by some fairly chunky institutional holders. So if those are all agreeing to it, then I think it's going to be a done deal. But I'm not convinced that's quite the end of the story here.
No, I suspect from what I've heard that there will be at least holding out for a few more pence. And it's worth making the point, I think, that this has been, if you like, a successful intervention or at least pressure from some of the largest shareholders. I mean, the discount came in, it was as wide as over 40% last summer, as you say, and it's now obviously come into what is effectively a 17% discount. So there has been significant movement there. What prompted all this, of course, was what some investors thought was a clear case of the management, or at least the board, not acting in the best interest of all shareholders, right? They were proposing to give a very cosy contract to the managers, and the shareholders haven't taken kindly to that. But I think it's fair to say that, I mean, PRS REIT is, I would still say, even though the share price, if it goes out 115p, hasn't delivered a huge return since it was launched, but it has put together a very impressive collection of private rental properties. And it's been doing what we think investment trusts should be doing, which is basically investing and building good portfolios of commercial property. And I think it's been a clear success story, apart from this issue around the discount and management. I don't know if you would agree with that. We'd like to see more of them, in other words, is what I'm saying. And private rental is, I think, still a very attractive area of investment.
Yes, but this was a unique trust. It was the only one doing what it was doing. And so when this disappears, as I think it will, then that sector is no longer available to you as an investment trust investor. And this was never really my favourite sector, because so many of us are accidentally overweight domestic property anyway through our own properties. But nevertheless, I think you're right. Its track record has been pretty good. It built this very large portfolio quite successfully. And it's a shame to see another subsector disappear, because we're seeing our choice restricted. And clearly, we talk about individual trusts the whole time, don't we? But actually, if you look at the broader picture, of course, it's very unhealthy indeed for the sector to be shrinking this rapidly. And it's removing a lot of choice, which is a great shame. And I don't know when it's going to be possible for new IPOs to come and give us some new options. Not in the near term, that's for sure.
Indeed. Though there are still other options, of course, across the broader market. And obviously, London Metric, for example, has been extremely well in consolidating the sector. I think one of the points that Marcus Fairmudge makes is that in one or two cases where private equity has been involved, it may be that one or two of these trusts do actually come back to the market in due course, though whether they come back in a different format or as investment trusts or as just a plain vanilla REIT, we'll have to wait and see. Anyway, on the same theme, let's talk next about Empiric. This is not one that gets a lot of airtime, I think. It's another interesting trust. It has a market capitalization of around 680 million, so it's not an insignificant vehicle by any means. What's happening here? What's the story with Empiric?
Yes, very, very much the same story again. And I think you're right. This is not a trust that's attracted that much publicity, but I do think it's been a takeover candidate for quite some time, probably since its rival peer, GCP Student Living, was taken over in the summer of 2021. So it's been quite a long time to wait, actually, for some action here. But it's all part of this continuing cannibalization of the investment company REIT sector. And again, here, Empiric has attracted a bid from Unite, the well-known larger listed REIT, a property company. And the offer here is a mix of cash and shares. So it's 30 pence in cash plus zero point zero 0.09 Unite shares. That sounds a tiny number, but actually these are highly priced shares. So actually that works out at about 105.5 pence per share, which gave you a little bit of an uplift to the share price, not much of a premium. And again, it's at a discount to the 119.6 pence year-end tangible asset value. So again, it looks like a reasonable bid, and there may be a little bit more to come from it, but I think it'll possibly go through. I think the interesting point here is that, again, there has clearly been pressure from underlying shareholders. And it's notable that the Achilles investment company, obviously backed by Harwood, has said that Empiric is its second largest holding. So possibly another successful exit for Achilles.
Yes, and a demonstration of that particular format seems to be bearing fruit, as you say, even if it means the consolidation of the commercial property sector and the elimination of some opportunities. Do you think that the market has basically got tired of student accommodation as a class? It hasn't done particularly well, this trust, over its history. It's been on the market for what, something like 10 or 11 years, and the share price today is, well, as you said, not very far different from where it was when it started. It does pay a yield, of course, and the current yield, I think, is around 3.6%. Do you think that this sort of experiment in student accommodation has been a success or not?
It's really hard to judge, actually, because, of course, these student property trusts were hit massively by the COVID crisis, where there were no students, there was no rental income, and that really was a difficult period for them because they were expanding very quickly at that point. And if you live in a big city like I do in Bristol, you know that many buildings have been repurposed now to become student flats as the student population has grown so much. And so there's clearly a need for what they're doing, and they've been very useful for our society, but they haven't been great as investments. You have had that yield, although again, that yield has not been a reliable one. That's the problem. It was cut obviously during the COVID period. And so I don't think these have been great trusts, but they haven't been disastrous either. And I think possibly going forward, there'll be quite good assets for these other companies to own. So again, I feel ambivalent about it. Whilst they're not the greatest trust, they were never top of my list. I'd much prefer they continue to exist because I think they might be quite good in the future. So it's a shame they're going.
Yes, I mean, the demand for student accommodation, I think, is still rising, though obviously the universities are suffering financially at the moment. There are lots of concerns about their sustainability in some cases, perhaps over expansion of the university field. Talking about property generally, then, we are against this background where there is, I think, again, hope that interest rates are going to be on a downward trend. In the last few months, we've seen bond yields being pretty firm and certainly the long end rising a little bit. But I do get a sense that perhaps the mood music there is changing a little bit as well. And if so, that would probably help to explain why the commercial property sector generally has, just apart from these bids, there is a kind of slightly stronger feel around it. I don't know if you have any views on the wider asset class dynamics here.
Well, I can certainly tell you what I've observed. I mean, you'll clearly get a far, far better insight next week from Marcus than you will from me. But I do think, actually, that's exactly right. I think you described it very nicely there as the mood music changing. It takes quite a while for the property sector to turn around. It's a supertanker, isn't it? And I definitely feel that probably towards the end of last year, we reached the trough here. And since then, generally the news has been better, even from fairly difficult bombed out sectors like offices. I really think actually the news flow is improving and we have seen investors moving back in. One of those factors, I think, is the expectation that interest rates will fall. And I think, again, against this fairly feisty geopolitical background, some investors are looking for more reliable yield. So we've seen actually in the property sector, and I think as well in others such as renewables and infrastructure, we've seen a pretty good rally actually. And I do feel there's quite a lot of demand coming through here. So, yes, an improving background, and let's hope that carries on.
Yes, there does seem to have been some kind of break in the correlation between bond yields and the yields on certainly renewables and infrastructure and so on more generally. So that does suggest that there are some bargain hunters out there, shall we say, who are looking forward to lower interest rate environment. Let's hope that's the case. Well, you mentioned alternatives and renewables. Let's talk next about SDCL Energy Efficiency Trust. That's certainly in the renewable sector, one of the more interesting idiosyncratic creatures, I think it's fair to say. What's the news coming out of this one? I don't follow SDCL particularly closely, but I think you do. So you're the perfect person to update me on what's going on there.
Well, I'm not surprised you don't follow it because I think it is idiosyncratic and it's a very odd trust, really. It's large, it's quite a significant trust. It has £1 billion worth of assets, and yet I don't think that many people know about it. And perhaps that's one reason why it's on a 47% discount. But it is an interesting trust. It has this collection of fairly chunky individual assets that it owns, many of them in the US actually, but it's run into some degree of difficulty. Perhaps difficulty is too strong a word, but I think some degree of pressure to start reducing its debt. And that's been a common factor, of course, across this entire sector as interest rates have risen. And the trust had said that it was expecting to sell one of its major assets called Onyx Renewable Partners, which is a clean energy business. And that was really to ease the pressure on its debt load. And we were expecting news of that sale to come through probably by the end of this month. However, the trust has said that, in fact, in the current American environment, a disposal has proven difficult to achieve on acceptable terms. So, in other words, they tried to sell it, found that they were not getting enthusiastic buyers willing to pay up. So, they've decided not to sell it. And that sounds like bad news, but actually, there is a salve here. So, they managed to find a sticking plaster to ease the wound. So, they are going to seek equity partners for some of the projects that Onyx is involved with. And Onyx has itself secured a new debt facility. Actually, again, quite large. It's a $260 million debt facility. But that means that Onyx can be self-funding now. So it does not need capital from the trust itself. So that eases the trust debt. So that wasn't the outcome expected, but the market actually initially thought that was quite good news and did mark the shares up. I think subsequently it's had second thoughts and it thinks, well, maybe this isn't really what we wanted and it's not an ongoing solution. And it does mean that the shares are still, I think, trading at quite a depressed level. So the discount is 47%, the yield is 12.9%, which is incredibly high and really generally indicates the market is a bit skeptical about that continuing. And it could be that the debt load is a problem. But generally speaking, I think historically that yield's been quite solid. So maybe it's one to look at.
Yes, I think it's fair to say it now has the distinction of being the second widest discount in the broader kind of energy and indeed infrastructure sector combined. I've just been looking at that data now. And as you say, one of the issues, a lot of these energy and infrastructure trusts is around not just the level of their debt, but their ability to refinance it, because if they do have to refinance, it will be at higher levels. So that could then threaten what was previously perhaps a viable debt structure, might make it unviable. So those ones are trading at what, around 47p, which is less than half the issue price. I said it's the second widest discount. The one with the widest discount in the kind of infrastructure, very broadly sector, is of course Digital 9 Infrastructure, DGI 9, which is really a fallen angel. I think we can describe it as that, trading at 9p. It has been perking up there in the last few weeks, interesting enough. If you like to speculate amongst the nearly dead, this has been one to look at. It's gone up from a low of, I think, less than 5p or something like that. So anyway, there's been more news out of this one. I know it's got quite a large retail following, this one. What's the news here?
Yeah, so if you like your food spicy and your investments the same way, then this is one for you. But it's been a terrible story, really, Digital Nine, and it's very much a fallen angel. It's done everything wrong. I mean, it bought poor quality assets, managed them poorly, and sold them in an even worse fashion. But it's been trying to sell its assets, basically, to get rid of its debt load and then start handing money back to shareholders. And the news last week was that actually it has completed the sale of its Sea Edge UK1 asset, which is a data center asset, really. And it wasn't that large. It was only 10.3 million of net receipts. But this is allowing the trust to repay its revolving credit facility. So it's another step on this road to returns. And the trust has said that it's likely to return 4.5 pence to shareholders in early 2026. So not yet. There's still a bit of a wait to come before you get any cash back. But the intriguing point here is that, according to fairly up to date stockbroker estimates, the NAV here is still around 33 pence per share. So that discount is mammoth. It's a 2/3 discount. And it does mean that if Digital Nine is eventually able to sell its assets at a reasonable price, it doesn't have to be a full price, but a reasonable price, then you're going to get actually a fairly chunky uplift here. But clearly, it's a very high risk position. And I think you just have to label it as a speculation at this point. And one extra point I'll make is just that the maths is quite interesting. When they repay that 4.5 pence, if they do, that will take the shares back down to around 5 pence, other things being equal, and the NAV then down to, let's say, 28. But that means actually that the maths just works out that the discount widens very considerably when that happens, when you hand back cash. And that can be a bit of a stimulus for a rally. So there's a bit of hope on the horizon, but you just have to treat this as a high risk situation, I think.
Yes, I think people should venture into it with their eyes open. I should correct myself. I think the year's low anyway was 7.5p, so now they're up to 9.4 or something like that, but there's quite a big spread in there, of course. So if you are tempted in getting involved in this one, you really need to be careful. And I'm not sure whether the platforms are still preventing some private investors from investing these things, unless you can pass their test as a sophisticated investor, because it is high risk. And of course, the broader point is when your asset value is queried, at least, it can take quite a long time to finalize the final deal if you're trying to liquidate a trust. And I can't quite remember, is there a risk of litigation around this one as well because of the very poor performance? I can't remember off the top of my head, but I rather think there might be, which is also another factor that can delay or cost money at least. You are listening to our Moneymakers podcast. We are an independent research and publishing venture and grateful to J.P.Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. So let's move on. Let's talk next about some rather different stories. And there's a lot of interesting things going on in small doses around the sector. Let's start with J.P.Morgan Indian. What's the story here? India has obviously been a spectacularly good market for most investors for a few years now, but the fortunes of individual trusts that track that market have been rather diverse, I think it's fair to say. So what's the news from J.P.Morgan Indian?
Yes, we talked about this last month, Jonathan, didn't we? And this is, I think, a good case of a bad trust in a good sector, but it's been subject to quite a lot of change. So after a strategic review, the board decided to keep the existing management, but they have made quite a few structural changes. And as part of that, they've introduced a 30% tender offer, which is coming up right now. So if you were a shareholder on the 10th of June, then you're eligible and you need to make your decision by early July. Depending on which platform you're using, it'll probably be sometime in that first week of July. And you have the chance to tender your shares in and to receive net asset value less costs. Now, I think there's a couple of moving parts here. One thing is that I think you'll get an uplift if you do that, because the current discount on the share price is 6.2%. But perhaps that's not really the right statistic to use, because actually what you really need to think about is, well, what is the discount going to be after the tender offer? And if you look at the discount over the last 12 months, it has tended to be in the high single digits or even higher actually before the strategic review. And the narrowest it's been over the last 12 months is 5.7%. So I think on that basis, actually coming out at pretty close to NAV looks like a good option. And there are costs here, so £930,000 of cost, which is a lot. I mean, it sounds like a big number, but actually, if you take the amount that could come out of the trust, which is 230 million, then it's only 0.4%. So perhaps the costs are not too bad. And I think it's a shame to see these trusts shrink. But if you're taking your individual approach here, your individual decision, it does make sense to come out in the tender.
So this is an interesting one because, of course, this trust, I think, passed a continuation vote not so long ago. It was last year, I think, that it passed a continuation vote. It has underperformed over 5 and 10 years, and it's the largest but also the worst performing Indian investment trust. But to be fair to it, of course, it started out, it was very much kind of the core Indian exposure type vehicle that wealth managers and others were looking for, whereas some of the other trusts in that sector, which have done extremely well, things like Ashoka and so on, are much more specialist in their approach. So perhaps you can't compare them directly. But having said that, the performance has been definitely disappointing. And clearly we're seeing this is the result of that. The Indian sector has obviously grown, it's expanded, and there's some interesting vehicles in there. Would this be one that you would think has some value as a core holding for exposure to India? Or are you like me? I have some holdings in one of the other trusts, which has done rather better.
I am like you, Jonathan. That's the short answer. Yes, I mean, we've been hearing for some time actually about how Indian equities are very expensive. And I'm not sure this is the moment to pile in. But actually, if you're a long term investor, India looks great and has done very well, of course. And I think the best thing of all, actually, is if you're a regular investor, then actually starting a savings plan to start investing regularly in India is probably quite a good, sensible thing if you're a younger person. But it's quite hard, I think, to pick J.P.Morgan Indian as the one you would go for, because if you're a small investor, if you're a private investor, you don't need the extra liquidity, which is the big advantage that J.P.Morgan Trust has. And I do think that Ashoka India has a very, very good track record indeed, and that's the one that I would prefer. Beyond that, actually, I'm not that big a fan of these single country investment trusts because their performance is so variable that often I think it's better to have a regional fund, but maybe India is a special case.
Yes, and there was certainly some rotation out of holdings of Indian equities into holdings of Chinese equities earlier this year, and that proved quite a profitable realignment if you followed that particular strategy. But I have to say, personally, I rather agree with you about the single country trusts, particularly if your emerging markets exposure is relatively small as part of your overall portfolio. Then by the time you get into single country trust, you're talking about what are pretty small parts of your portfolio that won't be able to move the dial significantly. But that's a personal choice, of course. Everyone has that option to make those decisions. While we're on emerging markets, let's talk about the grandfather of them all, or the grandmother of them all, I should perhaps say, which is the Templeton Emerging Markets Trust, the first ever emerging markets trust started by Sir John Templeton all the way back in the 1980s. They put out some results this week, and there's been a lot of talk, obviously, about perhaps the need to rotate out of the US into other parts of the world. Any clues about whether that's been a good idea or not in the TEMIT results?
Yes, you're right. This is a £2 billion trust, and it's the longest established. So it's very much the go-to trust, I think, for anyone seeking liquidity in the sector and seeking a good long history. And I've been following this trust for years and years. And I must say its performance has ebbed and flowed quite a lot over the years. But if you look at its long-term track record over the last 10 years, it's returned 7.7% a year on average, and it's been pretty good. And in the year to 31st of March, the last reporting period, again, the trust did quite well. It was up 8.8% in NAV terms, which was ahead of the benchmark, up 5.8%. And actually, since the year end, it's also been ahead of the benchmark. And my feeling looking forward is that emerging markets actually are creating quite a strong case for themselves at the present time. Interestingly, with the final results statement, the Templeton emerging managers said that valuations were attractive. And they did mention the currency tailwind, which I think is a really big point here, that historically emerging markets have profited from periods of dollar weakness. And my goodness, we're seeing dollar weakness at the moment. And potentially, with the challenges ahead for President Trump, we're going to see more and more dollar weakness. And I think he might actually encourage that. So that means that actually, for emerging markets companies, their debt, which is often denominated in dollars, is cheaper to service. They attract more capital inflows. And I do feel that if more and more investors are thinking about diversifying their portfolios away from the Magnificent Seven and away from the US tech sector, then actually China and Asia in particular, and also India, has a lot to offer. So my sense is that this could be a very good period to have some emerging markets exposure in your portfolio if you don't already.
And what about the discount on this one and the yield? You don't get much of a yield, obviously, on an emerging markets trust. It's typically, I think, around 3%. That's more than it used to be anyway. Shares are up 13% this year. Discount is still quite wide, right? It's at around 13%, something like that, which is in line with its more recent average. But you'd think there might be some scope for a bit of extra boost from discount narrowing as well?
I do. I think it's quite good value at a 12% discount. And you're right, that's not out of line with where it's been. But I do think if emerging markets come a bit more into vogue, and they have been pretty much out of favor for some time, then you should see that discount come into single digits. So you may get a bit of uplift there. But that's not really, I think, the reason for buying this. This isn't really a discount play, and it's certainly not an income play. It's really about long-term capital growth. And I think actually you're looking for reliability and solidity if you're looking for that kind of holding in your portfolio. And Templeton Emerging Markets probably gives you that.
So while we're on the subject of emerging markets, obviously the largest component in emerging markets is China, and there's been a lot of interest in China this year. And we also had some results from Fidelity China Special Situations, which is also, if I can use that term, the grandfather or grandmother of Chinese investment trusts, though not quite as long a history, obviously, as that of emerging markets generally. What have they had to say?
Well, this is really interesting, actually, because it had a cracking year. Again, the year to the end of March, the net asset value here was up 31.5%, which is slightly behind the benchmark, but nevertheless, I think it's a difficult benchmark to beat. So it was a very creditable outcome. And I did see a lovely stockbroker's headline, actually, that said, Anthony Bolton is finally proved right. Because you remember that he established this trust, and actually it went very badly initially, and he struggled to transfer the brilliant management techniques that he'd used to profit from UK equities across to China. They had some issues with fraud and so on. But actually, this trust has matured, and it's very much the largest trust in its sector. The obvious choice, I think, if you do want China exposure. And again, I think looking forward, things look quite promising here. The managers talk about really compelling valuations. They say that the forward PE ratio here is about 10 to 11 times. And you're going to be looking at probably more than double that if you're looking at the US. And the shares, I think, are quite attractive at the present time. You've got an 8.9% discount, which looks fine to me. And I think brokers are fairly positive about the trust. It does actually flex many of the great attributes of the investment trust structure. So this trust uses gearing. It uses 20% leverage typically, and that's been very helpful for it. It does also invest down the capitalization spectrum. So it's investing in a little bit of unquoted. So I think that's about 5% of the portfolio, but quite a lot of smaller and mid-cap companies. And it's the best in its sector. It's the best over 3, 5, and 10 years. And I think it's probably a pretty good trust to own if you do want to have Chinese exposure.
Yes, I mean, this has been going now for 15 years or so. And it did have that extraordinary spike after COVID, which rather distorted all the performance figures, if you like. But if you look at it, I mean, if it was launched at £1, it peaked at around £5. Hard to believe now, back in that extraordinary post-COVID period. And it's now, around £2.60 or £2.55, I think, something like that. And over the longer run, it's been a pretty steady performer. It's been compounding quite nicely. So, as you say, it's certainly, I think, widely seen as the quality vehicle in the Chinese sector. Of course, the bigger issues are whether you actually think that conflict between America and China is coming, and if so, what form will it take? Taiwan, is that really at risk, and so on. There are lots of issues around China, and not least the fact that 2 or 3 years ago there was that case where effectively the Chinese government just closed down the education sector in China. And so there's always the risk of some kind of regulatory or government involvement that wouldn't sit very well with investors. But as you say, at the moment, certainly it seems to be performing back in line with its longer term performance trend. So that's encouraging. A couple more quickly to get through. Let's talk next about worldwide healthcare. Not such a happy story, perhaps. Again, it's a very large trust and gives you exposure to healthcare. What's the story there? They put out some results as well.
And it's not a happy story. The annual results here, again to end of March, showed the net asset value down 10.3%, which is obviously poor in absolute terms. It's also poor in relative terms because the MSCI Health Index was down 3.2% over the same period. So quite considerable underperformance here by what is often thought of, I think, as the bellwether of the healthcare sector. The underperformance here was largely down to stock selection and the fact that worldwide healthcare is overweight in therapeutics and biotech, both of which suffered. It's a fairly high conviction portfolio, actually. It has just under 50 holdings, so it is going to vary from the index. But it's been pretty poor, actually, for a while. And the healthcare sector generally has been very difficult. President Trump has certainly put a damper on healthcare stocks. Well, in particular, his health secretary, of course, Mr. Kennedy. So it's been a tough place to be. But I think worldwide healthcare has really struggled. And that's maybe why Saba has taken a 5.4% stake here. And when I first looked at that, I thought, well, it looks a bit opportunistic to me because there's been a bit of a dip in performance. But then I looked into it a little bit more, and I feel actually that worldwide healthcare has been underperforming for a while. And if you compare it perhaps to Polar Capital Global Healthcare, that's been a much, much better trust, the Polar Capital one, over all periods. So I think maybe worldwide healthcare is going to find itself on the wrong end of some corporate activity here and maybe shrinking a bit.
Yes, I think that certainly looks like a realistic possibility to me. And so, as you say, the contrast between, well, we just talked about Fidelity China did up 30% over the last 12 months, NAV down 10%. That's quite a big shift, relative performance. Obviously, not much comparable about them, but it's typical perhaps of the volatility that we've been seeing in different sectors. Do you have other trusts in the healthcare sector more broadly, the biotech and healthcare sector that you like? They've all been struggling, I think.
Well, they have all been struggling against this very difficult background of the US regulatory and policy mandates. And of course, this is very much a US centric sector. So if you look over the last 6 months, actually, the NASDAQ Biotech Index is down about 4.5%, which is considerably worse than the broader market indices. So everything has suffered. But my feeling in this sector is that it's quite difficult to treat it as one homogeneous sector. There's quite a lot of differentiation between the trusts. And so my strategy here has always been to invest in one of the sort of larger mainstream trusts. And I think the Polar Capital Trust is the pick at the moment. That's PCGH. And then perhaps combine that with a smaller trust that has some earlier stage investments that can prove to be quite exciting at times. And my choice there is RTW Biotech Opportunities, which again hasn't been great of late. But I think if you look at the longer term management record there, it's exceptional. And that could really be a long term winner. So at the moment, it looks like a horrible place to invest. It's a depressed sector, it's very much out of favor. You probably wouldn't choose it if you're looking at the recent track record. But as we know, Jonathan, that can, of course, be the best time to buy.
Indeed. When everybody else is gloomy and selling, indeed. Well, finally, let's talk about something a little bit more cheerful, shall we? And let's talk about what's been happening in the growth capital sector. A lot of very different vehicles involved in this, but essentially these are trusts that invest in private assets, private equity, but at a relatively early stage compared to the more conventional private equity trusts. So we're talking about trusts like Schiehallion, we're talking about Chrysalis, we're talking about Seraphim Space, and you might also include things like HGen and so on. But anyway, what's your feeling about this sector? They have all perked up together, actually, pretty much. And that's quite encouraging for those of us who own one or possibly two of them, as I do.
Well, I'm encouraged. I must say I own even more than two, actually. But I think the point is probably here that we've come full circle from where we started the podcast on these geopolitical issues and the background here. And my sense is that For quite some time, actually, we've been in a fairly risk-off mood, and markets have not been wanting to own these very risky assets where the payoffs is quite some time in the future. So when interest rates rise, that means that actually those payoffs are not as valuable because they're some time down the road. And for that reason, these trusts were generally sold off. And it hasn't helped either that the IPO markets have basically been closed. So if you're a growth capital business, you own these early stage investments. At some point, you want to be able to realize your profits on those. And one of the classic routes to do that is by bringing them to market. And if that route is closed off, it makes it more difficult for you to establish the value in your portfolio. So they've been crushed actually for a while and then fell to very wide discounts in most cases. So in the case of Seraphim Space, the discount was wider than 50%. In the case of Hydrogen One Capital Growth, it was almost 80%. And you can extrapolate that and continue across the board, really, with these other trusts. But actually, when markets bounced in May, when I think there was a reassessment of the Trump tariff approach, these trusts really rallied quite strongly. And certainly, Hydrogen One Capital Growth and Seraphim Space have been quite dramatic performers over the last month or so. Depending on the exact dates you take, their rises have been somewhere between 25% and 50%. So you've certainly seen a bounce, and they're still on fairly chunky discounts. My sense is that some of them have come into reasonable levels now. So some of them are not quite the screaming buys they were. But if you look at Hydrogen One Capital Growth, for example, that discount's come in, but it's still 66%. So depending on the level of risk appetite, and I think to some extent what happens in the Middle East, there's potential, I think, for this rally to continue, but we'll have to see, I think, whether it's interrupted by broader news flow.
Yes, it certainly would not be a place to be if we go into a risk-off period, I think that's for sure. Though, of course, Seraphim Space has been making much of its defence exposure, so who knows, that might benefit from geopolitical tensions escalating, unfortunately, that being the way of the world. So I'm just looking at the performance year to date. Obviously, as you said, Hydrogen One is up 40%, Seraphim Space up 36%, but Schiehallion, which is the largest trust in the sector, is only up 1%. Chrysalis is actually down a year to date. So it's not been a totally uniform picture. I guess one could also look at Augmentum FinTech, that's down 8%. And of course, there's the sad dog that is now going out of business, the Schroeder Global. Sorry, what's it called again? I've forgotten already what it's called.
Schroeder Capital Global Innovation, I think, isn't it now? They changed the name so many times on that one.
Yes, the old Woodford Patient Capital, anyway. Let's be clear about that. Its name does escape me, perhaps for good reason. Right, so of those, what are your thoughts about Schiehallion? Obviously, that's a Baillie Gifford Trust. Do you think that's a bit disappointing? It hasn't actually sort of shared in this revival just yet?
I think part of the reason for that is that Schiehallien's portfolio is very heavily skewed towards the US. I'm not sure what the exact percentage is, but I think most of its largest holdings are definitely US based. And of course, there's a bit of reluctance on the part of investors to put more money in the US at the moment. I think as well the fact that the IPA markets are somewhat closed is a real drag because they have assets that are probably ready to launch on the market and that hasn't happened. That's true of Chrysalis as well. So it's going to be very interesting to see whether perhaps towards the end of this calendar year, whether the IPO markets reopen. And if they do, then I really do think there's great scope for uplift here. There's a lot of latent value in these trusts. It's just whether we can realize it, whether we can actually dig out the core of what's in there.
And do so before the patience of investors runs out, should we put it that way? Because they're all have not performed particularly well here to this date. Okay, Andrew, that brings us to the end of this podcast. Thank you again, as always, for your thoughts and insights. Look forward to the next one in about a month's time, where we will be moving towards the start of the holiday period. And then, well, there's always interesting things happen in August from experience. But we'll hope that there are not too many of those. So thank you very much. And as I say, at least until this morning's news, there were some signs of slight improvement in sentiment towards the sector that we both spend our time analysing. Next week, as I said, we will be hearing from Marcus Fairmuch, the manager of TR Property, always an interesting speaker and a great enthusiast as well, which means that will be slightly longer than normal podcast. After that, I am actually taking a holiday. I'm going off to Italy, and there will be a very short intermission before the next podcast, but I hope you'll indulge me in that. We've had some very interesting ones coming out twice a week for the last few months, and looking forward to the next ones that are coming up as well.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.